The $25 weekly investment plan, building wealth for retirement. You've probably been told that you need a fortune to start investing, that it's a game reserved for Wall Street suits, tossing around thousands of dollars like it's nothing. But what if that's not the whole story? What if the real secret to building a substantial retirement fund isn't some complex financial secret, but it's hiding in the spare change in your pocket, the cost of a few coffees, or just a simple $25 bill? Today, I'm going to show you exactly how to turn just $25 a week into a powerful, wealth-building machine that can truly secure your retirement. It's so much simpler than anyone has ever let on. And by the end of this, you'll have a clear, step-by-step plan to get started today. The high cost of doing nothing. Before we get into the how, let's have an honest chat about the why. Specifically, why just sitting on the sidelines is one of the biggest financial mistakes you can ever make. The biggest investing mistake isn't picking the wrong stock. It's not getting into the game at all. Every single day you wait, you're losing the one thing you can never, ever get back. Time for your money to grow. Let's talk about the silent wealth killer. Inflation. You know that feeling when you look at the price of gas or groceries and think, wait, wasn't this cheaper last year? That's inflation, and it's always at work. It's the slow, steady increase in the cost of everything, and it means the cash you have tucked away in a standard savings account is actually losing its power every single day. It's like you're running on a treadmill. You feel like you're working, but the finish line just keeps moving further away. A savings account might feel safe, but safety isn't the same as growth. In fact, with most savings accounts offering interest rates that are often far below the rate of inflation, that safe money is practically guaranteed to be worth less next year than it is today. Investing isn't about getting rich quick. It's about protecting your future self from the certainty of rising costs. It's about making sure your money is working for you, growing faster than inflation can eat it away. This isn't about risky speculation. It's about a smart, long-term plan. So the choice isn't really between investing and saving, it's between growing your wealth or watching it slowly evaporate. The why. Your $25 is more powerful than you think. Okay, so you're on board with the idea that you need to invest. But you're still looking at that $25 and thinking, come on, what can this little amount really do? Get ready, because this is the part where your whole perspective on money is about to shift. This is where we talk about the most powerful force in finance, a concept so profound it was supposedly called the eighth wonder of the world by Albert Einstein. Compound interest. Put simply, compound interest is just your money-making babies. It's the process of earning returns not just on your original investment, but on the returns themselves. It's a snowball effect. Your investment earns money, and then that money starts earning its own money, creating a cycle of growth that gets faster and faster over time. Let's break it down with your $25 a week. That's about $100 a month, or $1,300 a year. Now, let's assume you invest this consistently into a simple stock market fund. Based on history, the stock market's long-term average annual return has been around 10%. Keep in mind, this can vary a lot year to year, but we're playing the long game here. After 10 years of investing just $25 a week, you would have put in $13,000. But thanks to the magic of compounding, your account could be worth over $22,000. That's an extra $9,000 you did nothing for, other than just sticking with it. But here's where it gets really wild. The secret ingredient to compounding is time. Let's jump ahead 20 years. You've contributed $26,000. Your account balance? It could be getting close to $82,000. You've more than tripled your money. At this point, the interest on your interest is working harder than you are. Now let's look 30 years down the road, a pretty typical time frame for retirement planning. You've put in a total of $39,000. Your investment account could have snowballed to over $244,000. And if you start early, after 40 years, your total contribution of $52,000 could explode into a staggering portfolio worth over $637,000, all from $25 a week. Let that sink in for a second. You put in $52,000 over 4 decades, and your money did the rest, generating over $500,000 all by itself. This is the power you're about to tap into. Every $25 bill is a seed. And you're not just planting a seed, you're planting a tree that will one day grow, bear fruit, and drop its own seeds. This isn't a get-rich-quick scheme. It's a get-wealthy, slowly but surely plan. And it absolutely works. The crucial prerequisites to investing. I can feel your excitement. You're ready to go. But hold on. Before you dive in and open that first investment account, we need to lay down a solid foundation. Think of it like building a house. You wouldn't start putting up walls without first pouring a solid slab of concrete, would you? Investing is the exact same. Without a stable financial base, one little emergency can force you to sell your investments at the worst possible time, completely derailing your long-term plan. So there are 2 things you absolutely have to do before you invest your first dollar. First, pay off high-interest debt. I'm talking about credit card debt, payday loans, anything with a nasty double-digit interest rate. Think about it. It makes 0 sense to invest for a potential 10% return when you're paying a guaranteed 20% or 25% interest on a credit card. That's like trying to fill a bucket that has a giant hole in the bottom. The debt is a guaranteed loss that will almost always run faster than your investment gains. Attack that debt with everything you've got first. Second, build an emergency fund. Life happens. Your car breaks down, your roof starts leaking, or you face an unexpected job loss. An emergency fund is your financial firewall. It's a stash of cash, typically 3 to 6 months worth of essential living expenses, kept in a separate, easy-to-access, high-yield savings account. This isn't investment money. This is your sleep-at-night money. This fund means that when a surprise expense hits, you can handle it with cash instead of going into debt or, even worse, being forced to sell your investments. Selling early can lock in losses and steal all your future growth. Your emergency fund is what gives your investments the freedom to stay invested for the long haul. Seriously, don't skip these steps. I know it's the boring part. It's the financial equivalent of eating your vegetables before dessert. But getting your financial house in order is what transforms this $25 plan from a hopeful wish into a rock-solid, long-term wealth-building strategy. The how-to. Step 1. Choosing your investment account. All right, you've crushed your high-interest debt and your emergency fund is in place. Now for the fun part, opening the account where your wealth-building machine will live. This might sound complicated, but I promise you, it's incredibly simple. For a beginner using our $25 a week plan, you really have 2 main choices, a Roth IRA or a standard brokerage account. Let's start with the Roth IRA. An IRA is just an individual retirement account, and that Roth part is what makes it a superstar. With a Roth IRA, you put in money that you've already paid taxes on. Here's the magic. Once that money is in, it grows completely, 100% tax-free. And when you hit retirement age, which is 59 and a half, you can pull out everything. Your original contributions and all that amazing growth, without paying a single dime in taxes. It's huge. For 2025, the contribution limit is $7,000 a year, or $8,000 if you're age 50 or over. Our $1,300 a year plan fits comfortably inside that limit. The Roth IRA is specifically designed for retirement, making it an incredible tool that basically supercharges your compound growth by shielding it from taxes. Your other option is a standard taxable brokerage account. This is just a general-purpose investment account that lets you buy and sell things like stocks and funds. Unlike the Roth IRA, it doesn't have any special tax perks. You put in after-tax money, but then you'll owe taxes on any dividends you receive or profits you make when you eventually sell. So why would anyone choose this? One word: flexibility. There are no rules about when you can take your money out. If you think you might need this money for a goal before retirement, like a down payment on a house in 10 years, a brokerage account gives you that freedom. A Roth IRA, on the other hand, can have penalties if you withdraw the earnings before you hit retirement age. So, which one's for you? If your main goal is retirement, the Roth IRA is almost always the best choice for a beginner. That tax-free growth is an advantage that's nearly impossible to beat over a long period of time. Opening one of these accounts is as easy as setting up a new email address. You just go to the website of a big, reputable, low-cost firm like Fidelity, Vanguard, or Charles Schwab. They are all fantastic and offer both types of accounts. You'll fill out a quick online application, link your bank account, and you're good to go. The whole thing honestly takes less than 15 minutes. The how-to. Step 2. What to actually invest in. You've opened your account, and now you're staring at the screen. This is the moment that freezes most beginners. What do I actually buy? With thousands of stocks and funds to pick from, it feels totally overwhelming. But don't worry, I'm going to make this ridiculously simple for you. We are not going to try and pick the next Tesla or Amazon. Trying to find the winning lottery ticket stock is risky, exhausting, and for a beginner, it's a great way to lose money. Instead, we're going to use a strategy that is simple, proven, and incredibly powerful. We're going to buy a tiny piece of the entire stock market. You'll do this by investing in something called a low-cost, broad market index fund, or an ETF. Let's break that down. A stock is just a tiny piece of one single company. An index fund, on the other hand, is like a giant shopping cart that holds tiny pieces of hundreds or even thousands of companies all at once. An ETF is just a type of index fund that's super easy to buy and sell. The most famous index is the S&P P500. It tracks about 500 of the biggest, most successful companies in the US. When you buy an S&P P500 index fund, you're not just betting on one company to succeed, you're betting on the long-term success of the entire American economy. You instantly become a part owner of giants like Apple, Microsoft, and Amazon. This is called diversification, and it's your best friend. If one company has a bad year, it's balanced out by the 499 others. The best part? These funds are dirt cheap. You want to look for funds with a very low expense ratio, which is a small annual fee. Good S&P P500 funds have expense ratios as low as 0.03% or even less. That's a fee of just $3 a year for every $10,000 you have invested. So, what do you look for? Inside your new account, you can search for funds by their ticker symbol. Here are some of the most popular and respected S&P P500 ETFs and funds. VOO Vanguard S&P P500 ETF, IVV, iShares, Core S&P P500 ETF, FXAIX, Fidelity, 500 Index Fund, SWPPX, Schwab S&P P500 Index Fund. Any of these are a fantastic choice. Don't overthink it. Just pick one and stick with it. You're buying a diversified, low-cost, and proven engine for long-term growth. It's the most reliable path for a new investor. The how-to. Step 3. Setting it all on autopilot. This final step is the secret sauce. It's what separates the people who actually build wealth from those who just talk about it. This step ensures your plan runs on its own, quietly building your future in the background without needing your constant attention. We are going to put this whole thing on autopilot. Every major brokerage firm, Fidelity, Vanguard, all of them, lets you set up automatic, recurring investments. This feature is your new best friend. Instead of needing the willpower to log in and manually invest $25 every single week, you just tell the brokerage to do it for you. Think about your Netflix or Spotify subscription. That money just comes out of your account every month, right? You don't even think about it. We're going to apply that exact same powerful principle to building your wealth. Here's how it works. Once your account is open, you'll look for a section called Recurring Transfers, or Automatic Investments. From there, it's just a few simple clicks. 1. How much? You'll enter $25. 2. How often? You'll choose weekly. 3. From where? You'll choose your linked bank account. 4. To where? You'll select the index fund you picked in the last step, like VOO or FXAA. Confirm the plan, and that's it. You're done. From now on, every single week, $25 will silently move from your bank to your investment account and buy you more shares of your fund. It happens whether the market is up or down, whether you're feeling excited or scared. It just works. Automating your investments does two critical things. First, it makes you consistent, which is the absolute key to winning this game. Second, it takes all the emotion out of it. You won't be tempted to skip a week because the news sounds bad, or try to guess the perfect day to buy. The plan just runs. This simple act of automation is probably the most important step in this entire process. It turns your good intentions into real, concrete action. Addressing the big fear. What if the market crashes? Okay, we've built the plan. It's simple, it's automated, and it's powerful. But I know there's still that little voice in the back of your head, the one that gets louder when you see scary headlines about the stock market. It's asking, but what happens when it all crashes? Won't I lose everything? This is the biggest fear that keeps people on the sidelines, so let's face it head on. First, you have to understand that market downturns, the ups and downs, are a normal, unavoidable part of investing. Crashes are not a matter of if, but when. They happen. But here's the key. Historically, every single market crash in US history has eventually been followed by a recovery and a brand new high. And for a long-term investor like you, those downturns aren't your enemy. They can actually be your best friend. Your $25 weekly plan turns market dips into a superpower through something called dollar cost averaging. You don't need to remember the name, just the idea. Since you're investing the same amount of money every week, when the market goes down and prices are low, your $25 automatically buys more shares of your fund. Think of it like a sale at your favorite store. When things are 50% off, you can get more for your money. When the market is on sale, your automated plan is busy scooping up assets at a huge discount. Then, when the market eventually recovers, you own all those extra shares that are now climbing in value. This process of buying consistently through thick and thin smooths out your average cost and can seriously boost your returns over the long run. People who panic and sell during a crash are just locking in their losses. People who keep investing automatically are busy buying at bargain prices. Your job isn't to predict the market. It's to stay in the market and trust the process. This plan is designed to survive those storms. Remember, you're not investing for next year. You're investing for 20, 30, or 40 years from now. Over that kind of time, market crashes start to look less like terrifying cliffs and more like little speed bumps on a long, steady road heading up. So when the market gets shaky, don't panic. Smile. Your automated plan is doing exactly what it was built to do. If this has helped clear things up and made you feel like you can finally get started, do me a quick favor and hit that subscribe button. My whole goal here is to make personal finance simple and actionable so you can build real, life-changing wealth. And I want us to be a community of action takers. So, if you're committing to starting your own $25 weekly plan after watching this, let me know in the comments below. Just write, "I'm starting my $25 plan." There's a ton of power in making that public commitment. We've gone over a lot, but the main idea couldn't be simpler. You don't need a fortune to start building your retirement. You don't need to be a Wall Street genius or stare at confusing charts all day. All you need is a little bit of money, a simple plan, and the discipline to be consistent. That's exactly what the $25 weekly plan is. It's a clear, actionable path that cuts through all the noise and fear. It uses the unstoppable power of compound interest and the proven growth of the market, and it puts your financial future on autopilot. This lets you get on with living your life while your money is working tirelessly for you in the background. The biggest mistake you can make is waiting for the perfect time or for when you have enough money. The perfect time is right now. Enough money is that $25. It isn't just spare change, it's the foundation of your financial freedom. Start today. Start small. But for your sake, just start. Your future self is going to thank you for it.